Helium uses backtesting to identify trading strategies with high returns and low drawdowns. Unlike premium printer and cheap convexity, which update every day in response to market prices, Helium's backtests look over historical data to identify rules that make a profitable and robust trading strategy. Let's find a trade. This trading strategy has an average annualized return of 28% and a Sharpe ratio of 1.8. Sharpe ratio is returns above the risk-free rate divided by the standard deviation of returns. The average profit and loss from opening this position historically was $23, and Helium thinks this would require $38 of capital to open this trade. So what is the graph telling us? The blue line is cumulative percent return over time, and the orange line represents realized returns or captured profits. For this backtested strategy, Helium opened 92 trades, each with an average duration of about 33 days and a success rate or probability of profit of 77%. One thing to be aware of is that since the number of kinks in the orange line, or realized return, is relatively small, this means that the real sample size is probably a lot less than 92. Helium opens a trade every day that the strategy criteria is met. Helium's models are always trying to bridge the gap between high return and high robustness, or performance over long time periods. Let's look deeper into this strategy. Buying one call 18% out of the money, expiring in about 70 days. Historically, this trade was only opened if the following rules are met: a minimum volume of 4, a minimum open interest of 3 contracts, and a minimum gamma theta ratio of 5. You can think of the gamma theta ratio as a measure of positive convexity to time decay. After opening this position, Helium takes early profits at 70% at the initial debit paid, and early closing after 59 days. You can click Download Trade Log to see all the historical trades made in this simulation. Since this strategy involves buying 18% out of the money call options, this strategy needs a big upside move or increase in uncertainty to be profitable. Since this trade is early profit taking at 70%, we don't necessarily need a big upside move to make money on this trade. Since this trade is long options, we're also long volatility or future uncertainty. The price of being long options is strategy time decay, or the daily rent of owning this options position if nothing else happens. Since Helium's backtests represent simulated and not real trading, always take it with a grain of salt. Backtest bias is the ability to fool yourself into thinking that you have a profitable strategy, when in fact you do not. To battle backtest bias, Helium tries to optimize for trading strategies with a variety of features like high annualized return, small drawdowns, consistent returns over time, a large number of trades, and small standard deviation of returns. Interested in diving deeper? Click the How Helium's Backtesting Works button. Nothing in this video constitutes investment advice, performance data, or any recommendations. Helium is not responsible in any way for the accuracy of any model predictions or price data. Helium trades is for informational purposes only, and not responsible for any of your investment decisions.